Hi, welcome to Market Mettle. Do you know the hidden secret of how the bankers and brokers make money from your hard earned money? Fred Schwed revealed it in his book, Where Are the Customers Yacht in 1940. It's been over 80 years and the common man has still not learned it. Like this video and subscribe to Market Mettle to be on a fun filled journey of learning finance. Let's talk what the big boys don't want you to know. To know this secret, we first need to understand how this finance industry works. There are two sides of this industry. The depositor side, they are the banks and the insurance companies, and the service provider side, the brokers. The bankers and the insurance companies make money when you deposit your money or buy their policies. The service provider side make money when you do a buy or a sell transaction. Let's talk about the depositor side of the financial industry. A few days ago, I received a call from a financial advisor trying to sell me a guaranteed wealth plan. One of those schemes where you invest 5 lakhs every year for 6 years and then after 20 years you are promised a return of 1 crore. At first glance, it sounds tempting. But here's the thing, whenever you come across offers like this, always calculate the compounded return, the actual rate at which your money is growing. And don't rely on their pamphlets and glossy brochures to do this. Do the math yourself. It's actually quite easy to calculate using Excel. What you need to do is to find the IRR, the internal rate of return of the investment. IRR tells you at what rate your money is compounding. For example, if your money doubles in 5 years, the return is about 15%. If it doubles in 10 years, the return is around 7%. IRR is especially useful when you are making multiple payments like in an insurance policy or an SIP. Now let's come back to that wealth plan. If you calculate the IRR, you will find that your money is growing at only 7% annually. Sounds okay? Not really. Because if your return is not outpacing inflation, you're not growing. To know more about inflation, watch the previous video. Link is in the description. If your return is lesser than inflation, your purchasing power is actually decreasing. That means even if you receive 1 crore in the future, you won't be able to afford what you can afford today. Your standard of living will drop. In simple terms, this product isn't designed for you to make wealthy. It is structured to keep you poor. Now, 1 crore might sound like a big amount today, but don't forget, you will be receiving it in 20 years from now. Instead, if you invest the same money in a simple passive index fund, your money would grow at an average annual return of 15% and would be worth over 3 crores in the same time period. Even if you earn a slightly lower return, say 13%, you still end up with a significantly more than what this so-called guaranteed plan offers. So why do banks and insurance companies push this product so hard? Because they make more money from them. These plans are advertised aggressively and the agents earn hefty commissions on every sale. For an argument, the banker would say that we provide tax benefit and insurance coverage. Let's talk about it. A 2 crore term insurance would come in around 1500 to 2000 rupees per month depending on your age and other factors. And instead of investing 5 lakhs a year, you simply invest 10,000 rupees per month for 20 years. That would be 24 lakhs plus 4 lakh 80,000 totaling to 28 lakh 80,000. Less than what you have invested in the safe and secure wealth plan and getting much better return with higher insurance coverage. Even if you have to pay a long-term capital tax, you still make more money. Remember, just because something sounds safe doesn't mean it's in your best interest. Now, let's talk about the second side, the brokers. These are the people who encourage you to take risk and invest in the stock market. But even here, many investors fall into a trap. When you sign up for any service from the broker, they will offer you free training, stock tips, market updates, all bundled together as value-added services. And most people happily accept them. After all, who doesn't love freebies? But here is what you need to understand. When you study stories or watch interviews of truly successful investors, those who have actually built wealth to the stock market, they all say the same thing: buy and hold, because the stock market is a mechanism that transfers money from the impatient to the patient. Now think about it. If everyone simply bought and held their stocks for long term, how would brokers make money? The truth is, if the brokers helps you become rich, he becomes poor. That's a conflict of interest. So they do? They keep you engaged with constant stream of updates, tips and analysis, telling you why the market went up today or why it crashed or why a certain stock performed a certain way. It feels like you're learning a lot, but in reality, these daily fluctuations aren't very useful for long-term wealth building. Even people who discover the stock market with good intentions often fall into a trading trap. They keep asking, when should I buy? What should I buy? When should I sell? And brokers and media channels fuel this behavior. They convince you the only way to make money is by constantly buying and selling. That's why in today's world, holding a stock for 15 to 20 years sounds like stupidity to most people, when in fact it's the smartest thing you can do. Now, here is something interesting. The same people who want to double their money through fixed deposit in 7 years also expect to double their money in the stock market in just a week. They assume that's how the market works, and that becomes their basic expectation. That's why most people end up investing in FDs and insurance policies for long term and turn to stock market trading for short term. But when you do this, you are not really building wealth for yourself. Instead, you are helping both the sides of the financial industry, banks and the brokers, make money off your confusion. Now, here is what you should actually doing. Use FDs and debt instruments for short-term needs where safety and stability matters, and use stock market for long-term investment where time and patience can multiply your wealth. And I'm not saying this so you run off and start investing based on random stock tips. I'm saying this so you understand you need to invest based on your own research and common sense, because no one can manage your money better than you. Even if you scroll through every video on YouTube or every post on social media, you will mostly find people telling you what to buy, when to sell. They will say things like, this big investor just bought this stock at this price. But here is the truth they don't emphasize. That big investor made most of his wealth not by trading, but by holding. Take Mr. Vijay Kedia for example. He bought shares of Cera Ceramic and held on to it over 2 decades and selling it in 2022 with a return of over 16,000 times. His initial price was Rs 40 per share, and today the stock is trading over 6,000. Today the stock went up by 70. Now imagine trying to achieve that by trading. Buying at 40, selling at 50, buying at 55, selling at 65. It sounds exciting, but it's not realistic, because every time you trade, your returns are not guaranteed. But do you know what is guaranteed? Brokerage fees, transaction charges and taxes. Those are guaranteed and they eat up into your profit. So while you might be trading hard, it's the brokers and agents who make guaranteed money. And that, my friend, is the real secret of the stock market. Those who understand this make money. Those who don't pay money. Get this right, and you shift from being a customer of the financial industry to being a beneficiary of it. I hope you found this video interesting and insightful. If you did, please like, share, and subscribe to Market Mettle.